Why do smart people make terrible financial decisions? Picture this. A seasoned investor with decades of experience watches their stock portfolio drop 15% in a week. Logic says hold steady, the fundamentals haven't changed, but panic takes over and they sell everything at the bottom, locking in massive losses. 3 months later, the market rebounds and they've missed it entirely. This isn't stupidity, it's psychology, and it costs investors billions every single year. Welcome to Behavioral Finance, where we explore the fascinating intersection of human psychology and money. I'm going to show you why your brain is literally wired to make bad financial decisions, and more importantly, how to outsmart your own mind. Let's start with a question that reveals everything. Would you rather have a guaranteed $900 or a 90% chance of winning $1,000? Most people choose the guaranteed 900s. It feels safer, right? Now here's the flip side. Would you rather have a guaranteed loss of 900 or a 90% chance of losing $1,000? Suddenly, most people gamble. They'll take that 10% chance of losing nothing, even though mathematically both scenarios are nearly identical. This is called loss aversion, and it's one of the most powerful forces in behavioral finance. We feel losses about twice as intensely as equivalent gains. Losing $100 hurts way more than winning $100 feels good. And this isn't just theory. Loss aversion explains why people hold on to losing stocks for years, hoping they'll bounce back, while selling winners too early to lock in gains. It's why investors panic sell during market crashes and miss the recovery. It's why people stay in terrible jobs, bad relationships, and keep subscriptions they never use. Your brain is trying to protect you, but it's using Stone Age software in a digital world. Let me introduce you to another mental trap: anchoring bias. Imagine you're shopping for a laptop. The first one you see costs $2,000. The next one is $1,200. That second laptop suddenly feels like a bargain, right? But what if I told you that exact same laptop was $800 last month? That initial $2,000 price anchored your perception. Your brain latched onto the first number it saw and used it as a reference point for everything else. Retailers exploit this constantly. Was $190, now $99. The original price might be completely made up, but it works because your brain anchors to that first number. In investing, anchoring is deadly. People anchor to the price they paid for a stock. I bought it at $50, so I'll sell when it gets back to $50. But the market doesn't care what you paid. That $50 is irrelevant. What matters is whether the stock is worth holding today, right now, based on current information. Here's where it gets really interesting: confirmation bias. Your brain is not a neutral observer. It's a lawyer arguing for what you already believe. Let's say you think electric vehicles are the future, so you buy Tesla stock. Suddenly, you notice every positive Tesla headline. New factory opening? You see it. Record deliveries? Front page of your mind. But recalls, production delays, competition from other manufacturers, your brain conveniently filters those out. This isn't conscious. You're not deliberately ignoring bad news. Your brain is automatically seeking information that confirms your existing beliefs and dismissing information that challenges them. Investors fall into echo chambers, following analysts and influencers who share their views, creating a feedback loop that reinforces their biases until reality crashes the party. Now let's talk about one of the most dangerous biases in finance: overconfidence. Studies show that 93% of American drivers believe they're above average. Mathematically impossible, right? But we all do this with investing too. After a few winning trades, investors start believing they've cracked the code. They increase their position sizes, take bigger risks, and stop doing due diligence. I've got a feel for the market now. Here's the brutal truth. In one famous study, professional fund managers who were most confident in their stock picks actually performed worse than those who expressed uncertainty. Overconfidence led them to overtrade, ignore warning signs, and hold losing positions too long. The market has a way of humbling everyone eventually. The question is whether you'll learn the lesson before it costs you everything. Let me tell you about herding behavior and why it's responsible for every financial bubble in history. Humans are social creatures. For thousands of years, following the crowd kept us alive. If everyone's running from the watering hole, you run too. You don't stop to analyze whether there's actually a lion. But in financial markets, following the herd leads you straight off a cliff. The dot-com bubble, The housing crisis, cryptomania, GameStop, every single bubble follows the same pattern. Prices rise, media coverage intensifies, friends and family start making money, and suddenly you feel like an idiot for sitting on the sidelines. So you jump in right near the top just before everything collapses. This is FOMO, fear of missing out, and it's hurting behavior on steroids. You're not making a rational investment decision. You're following the crowd because being wrong alone feels worse than being wrong together. Here's a related concept that'll blow your mind: the availability heuristic. Your brain judges the probability of events based on how easily you can recall examples. Plane crashes get massive media coverage, so people overestimate the danger of flying while underestimating the risk of driving, even though you are far more likely to die in a car accident. In investing, whatever's in the news feels more important than it actually is. A market crash gets 24/7 coverage, making people think crashes happen all the time, when historically, markets go up about 70% of the time. A hot stock tip from a friend feels more reliable than boring index fund data, even though the data is far more predictive. Your brain prioritizes vivid, recent, emotional information over statistical reality, and that's expensive. Now let's discuss mental accounting, one of the sneakiest biases. Money is money, right? A dollar is a dollar, but your brain doesn't see it that way. People treat found money differently than earned money. Win $1,000 at a casino? You might blow it on something frivolous, but $1,000 from your paycheck? That goes into savings. Tax refunds feel like free money, even though it's literally your own money that the government held interest-free all year. People splurge on refunds while struggling to save from their regular income. Investors do this too. They'll take huge risks with house money, profits from previous trades, while being ultra conservative with their initial investment. But it's all your money. The market doesn't distinguish between your principal and your gains. Mental accounting also explains why people carry credit card debt at 20% interest while keeping money in a savings account earning 1%. Logically, you should pay off the debt. But psychologically, that savings account feels like security, even though it's costing you money every single day. Let's talk about recency bias, because this one is crushing investors right now. Your brain gives disproportionate weight to recent events. Whatever happened lately feels like it'll keep happening forever. Market's been going up for 3 years. People start believing it'll never go down. This time is different. Spoiler alert, it's never different. Market crashes? Suddenly everyone's convinced we're heading into a decade-long depression, even though historically recoveries happen faster than people expect. Recency bias makes you buy high and sell low, the exact opposite of what you should do. You pile into assets after they've already surged, and you dump them after they've already crashed. The best investors do the opposite. They're greedy when others are fearful, and fearful when others are greedy. But that requires overriding your recency bias, which is incredibly difficult. Here's a bias that affects every single decision you make: the sunk cost fallacy. You've invested time, money, or effort into something, so you keep investing more, even when it's clearly not working. You've watched 4 episodes of a terrible show, so you finish the whole season because you've already invested the time. You've spent $500 fixing an old car, so you spend another $500, then another, even though buying a new car would be cheaper. In investing, this looks like holding a losing stock because I've already lost so much, I can't sell now. But every day you hold it is a new decision. The money you've already lost is gone. The only question that matters is, would you buy this stock today, right now, at the current price? If the answer is no, you should sell. Past costs are irrelevant, they're sunk, but your brain can't let go. Now, here's the big question. If our brains are so bad at this, how do we actually make better financial decisions? First, awareness. Just knowing these biases exist makes you less susceptible to them. When you feel panic during a market drop, you can recognize it as loss aversion and recency bias, not reality. Second, create systems that remove emotion from the equation. Automatic investing, dollar cost averaging, rebalancing on a schedule, not checking your portfolio every day. These systems work because they bypass your psychological weaknesses. Third, diversification. You can't predict the future, and neither can your biased brain. Spread your risk across different assets, sectors, and geographies. Diversification is the only free lunch in investing. Fourth, take the outside view. Instead of asking, "What do I think will happen?" ask, "What usually happens in situations like this?" Historical data beats gut feeling every single time. And finally, get a second opinion from someone with no emotional stake in your decision. A good financial advisor isn't just managing your money, they're managing your behavior, stopping you from making emotional decisions that destroy wealth. Behavioral finance teaches us something profound. The biggest risk in investing isn't market volatility. It's not economic crashes or geopolitical chaos. The biggest risk is you, your own psychology, your biases, emotions, and mental shortcuts. But here's the empowering part. Unlike market crashes, which you can't control, you can control your behavior. You can learn to recognize your biases. You can build systems that protect you from yourself. You can make better decisions. The investors who succeed long term aren't the smartest or the ones with the best information. They're the ones who understand their own psychology and have the discipline to override their instincts when necessary. So the next time you're about to make a financial decision, pause. Ask yourself, am I being rational or is this loss aversion, overconfidence, hurting behavior, FOMO? That pause, that moment of self-awareness could be worth millions over your lifetime. Because in the end, behavioral finance isn't just about understanding markets. It's about understanding yourself, and that's the most valuable investment you'll ever make.